The year 2008 will forever be remembered as the year of the global financial crisis. The world witnessed one of the worst economic downturns in modern history, as major financial institutions collapsed, and millions lost their jobs, homes, and life savings. It all began with the bursting of the U.S. housing bubble, which had been fueled by subprime mortgages that were being issued to borrowers with poor credit. As the housing prices began to decline, many borrowers were unable to keep up with their mortgage payments, and defaults began to rise. As the defaults increased, the value of the mortgage-backed securities that had been sold to investors began to plummet. This caused a chain reaction of financial losses, as banks and other financial institutions that had invested heavily in these securities found themselves in trouble. One of the most high-profile casualties of the crisis was Lehman Brothers, a major investment bank that had been in business for over 150 years. When Lehman Brothers declared bankruptcy in September 2008, it sent shockwaves throughout the global financial system. As banks began to fail, the credit markets froze up, and businesses and consumers found it difficult to obtain loans. This led to a widespread economic slowdown, as businesses were forced to cut back on investment and hiring, and consumers cut back on spending. The stock market also suffered a major decline, with the Dow Jones Industrial Average dropping by over 50% from its peak in 2007. This wiped out trillions of dollars in wealth, as investors saw their portfolios shrink. In response to the crisis, governments around the world implemented a range of measures to stabilize the financial system and stimulate economic growth. Central banks lowered interest rates and injected liquidity into the banking system, while governments provided fiscal stimulus in the form of tax cuts and infrastructure spending. However, these measures were not without controversy, with many people questioning whether the bailouts and other interventions were fair and effective. Some argued that the bailouts amounted to a transfer of wealth from taxpayers to Wall Street, while others argued that the government was not doing enough to help struggling homeowners and ordinary workers. While the effects of the financial crisis are still being felt today, there are signs of recovery in many parts of the world. The stock market has rebounded, and unemployment rates have fallen in many countries. However, the lessons of the crisis are still being studied and debated, as policymakers and economists try to prevent a similar crisis from happening in the future.